We have sales up a little bit at Ford, down at General Motors, like we talked about yesterday. Nissan's in trouble, Stellantis is in trouble, and Toyota and Honda both had fewer sales than anticipated.
It's happening. The car market is in full-blown collapse. The 2025 crash has started, and no dealership, car owner, or manufacturer will escape the fallout. Every corner of the industry is cracking. Unsold inventory is piling up, loans are being denied, and repossessions are skyrocketing. If you thought the pandemic disrupted the car market, think again. This is much, much worse. Why are dealerships struggling to sell even America's most popular vehicles like the Ford F-150? How did car prices rise so high that buyers are abandoning their auto loans? What does this collapse mean for your vehicle's trade-in value and the cost of buying a new car? Stick around because this crash isn't just about cars, it's about your financial future, and it's worse than you thought. What's happening? The first visible sign of the 2025 car market collapse is the mountains of unsold vehicles gathering dust on dealership lots. Take the Ram lineup. Over 25,000 brand new Ram 1500s, 2500s, and 3500s have been sitting unsold for over 220 days. These aren't obscure models, they're flagship trucks that used to fly off the lots. And it's not just Ram, Ford F-150s, America's best-selling vehicle, are also piling up. Even Toyota, known for its reliability, is struggling to move vehicles like the Tundra and Tacoma. How did we get here? One reason is clear: prices have spiraled out of control. Consider this: a base model Toyota Tacoma SR5, which used to cost around $30,000, is now priced at $43,000. The Toyota Tundra, once a favorite among working-class buyers, now often exceeds $75,000 for higher trims. The target buyers, hardworking Americans looking for utility and value, have simply been priced out. The pandemic-era shortages that drove prices sky high have left a lingering effect, but the market's correction hasn't come fast enough. Dealerships are stuck paying flooring costs, a kind of interest payment for every car sitting on their lot. Every day a vehicle sits unsold, it costs them more money, pushing them closer to financial disaster. The problem: the unsold inventory is just the surface. Beneath it lies a web of problems that are driving the car market into collapse. At the heart of the issue are soaring manufacturers' suggested retail prices, which have risen by a staggering 42% since 2019. Vehicles that were once considered affordable are now luxury purchases. Take family staples like the Toyota RAV4 or the Honda CR-V. Today, a new RAV4 is priced around $39,000. A Ford Explorer, another family favorite, often exceeds $60,000. This pricing disconnect has created a crisis of affordability for the average consumer. Then there's the financing problem. The average monthly payment for a new car in the US is now over $760, with 1 in 6 buyers locked into loans exceeding $1,000 per month. Even worse, interest rates have surged, with averages of 7.2% for new cars and 11.4% for used cars. These high rates have made loans almost impossible for many buyers, with 1 in 5 auto loans now being denied by banks. As if that weren't enough, insurance premiums have doubled in just 2.5 years, with annual increases of 50 to 60% in many states. Combined with rising costs of living, owning a car is no longer feasible for many families. The car market has created the perfect storm, where prices are too high, financing is out of reach, and everyday people are left with no options. The ripple effects. This market collapse doesn't just impact dealerships and manufacturers, it's hitting consumers where it hurts. The first domino to fall is repossessions. When families can no longer afford their car loans, the vehicles are repossessed and flood the market. Repossession rates have surged by 23% in the past year, the highest jump in decades. But here's where it gets worse. These repossessed cars drive down the value of all used vehicles. The national average for negative equity, where car owners owe more than their vehicle is worth, has ballooned to $7,200. For 1 in 5 borrowers, that figure is over $10,000. What does this mean? If you bought a new car recently, chances are you're trapped in a loan that's worth far more than the car itself. Dealerships, in turn, are forced to offer massive discounts on new inventory just to stay afloat. It's not uncommon to see $10,000 to $15,000 slashed off the price of trucks like the Ford F-150 or Ram 3500. But even these discounts aren't enough to move inventory in a market where buyers are increasingly cautious or outright unable to qualify for financing. For the industry, the implications are dire. Manufacturers are seeing their flagship vehicles go unsold. Dealerships are watching profits evaporate evaporate under the weight of high flooring costs and discounting, and consumers are losing trust in an industry that seems to have priced itself out of existence. The ripple effects extend far beyond the car market, impacting local economies, job markets, and even global supply chains. So, how did we reach this breaking point? What role did the pandemic and its aftermath play in creating this unsustainable system? And is there any hope for recovery? A pandemic hangover. The roots of the car market crash of 2025 stretch back to the chaotic economic conditions of the global pandemic. During those unprecedented times, supply chain disruptions, factory shutdowns, and material shortages created an environment of scarcity in the automotive world. Dealership lots emptied out almost overnight as demand far outpaced supply. Buyers were clamoring for vehicles, even paying inflated prices just to secure transportation. This situation led to a phenomenon that would plant the seeds of today's collapse: the artificial inflation of prices. Automakers and dealerships alike took advantage of the situation by raising prices significantly, knowing that desperate buyers had little choice but to pay. Vehicles that once sold at or below the manufacturer's suggested retail price were suddenly marked up by tens of thousands of dollars. By the time production began to normalize, the market had grown accustomed to these inflated prices, and manufacturers were reluctant to scale them back. At the same time, interest rates were historically low. Buyers could secure loans with rates as low as 1 to 3%, making these inflated prices feel more manageable. This combination of artificially high vehicle prices and historically low financing rates masked the growing bubble that was forming beneath the surface. Now, as we sit in the aftermath of the pandemic's economic distortions, the cracks are showing. Manufacturers have not fully adjusted prices back to pre-pandemic levels, and the era of cheap money is long gone. This has created a perfect storm of unaffordability, where the average buyer can no longer justify the cost of a new vehicle. The insurance crisis. While much attention has been given to rising vehicle prices and financing rates, there is another factor that has quietly exacerbated the car market crash: the explosion of insurance premiums. Over the past 2.5 years, insurance costs have doubled in many parts of the United States. Some states have seen annual increases as high as 50 to 60% year over year. These staggering hikes are leaving many car owners struggling to keep their vehicles insured. This sharp rise in premiums is not just an isolated issue. It's tied directly to the rising cost of vehicle repairs and replacement parts. Modern cars, equipped with advanced technology like lane departure systems and automatic braking, are more expensive to repair than ever before. A minor fender bender that might have cost a few $100s a decade ago can now result in repair bills totaling thousands of dollars. Insurance companies have been forced to pass these costs onto consumers, further straining household budgets. For families already grappling with rising living expenses, groceries, utilities, rent, and medical bills, these insurance increases often become the breaking point. Many drivers are choosing to forego comprehensive coverage, or in some cases, letting their policies lapse entirely. The result? A market flooded with uninsured or underinsured drivers, increasing the financial risk for everyone on the road. This further discourages vehicle ownership, especially for those on the brink of financial instability. It's a vicious cycle, one that continues to drive the car market deeper into collapse. Trapped in a financial pit. One of the most alarming trends in the current car market is the skyrocketing rate of bank denials for auto loans. At present, 1 out of every 5 applications for a car loan is being rejected outright. Why? Because lenders are tightening their standards in response to the growing number of defaults. Auto loan debt in the United States is at an all-time high, and banks are increasingly unwilling to take on new risks. For those who do manage to secure financing, the situation is not much better. Negative equity has become a widespread issue, with the average car owner owing $7,200 more on their loan than their vehicle is worth. For 1 in 5 borrowers, that figure climbs above $10,000. This means that many consumers are effectively stuck in their current loans, unable to trade in or upgrade without taking a significant financial loss. This issue of negative equity is particularly devastating for buyers who purchased vehicles during the pandemic at inflated prices. Those vehicles have since depreciated rapidly, leaving owners with loans that far exceed the current market value of their cars. It's a financial pit with no easy way out. The implications of this trend go beyond individual borrowers. As more and more people find themselves underwater on their car loans, the broader economy feels the strain. Defaults increase, repossessions rise, and banks grow even more cautious about issuing new loans. This feedback loop only accelerates the market's downward spiral. The promise that fell short. Electric vehicles were once heralded as the future of the automotive industry, with promises of environmental benefits and lower long-term costs. And for a time, they seemed poised to take over. However, the reality of the electric vehicle market has fallen far short of expectations, contributing to the larger crash. One major issue is the cost of electric vehicles. While government incentives and tax rebates initially helped to offset these expenses, many of these programs have now been scaled back. The result, buyers are left facing price tags that often exceed $75,000 for mid-range electric vehicles and well over $100,000 for higher-end models like the Hummer electric vehicle. Compounding this issue is the dramatic decline in electric vehicle resale values. As new models with improved range and features are introduced, older electric vehicles lose value at a much faster rate than traditional gasoline-powered cars. For buyers who finance their electric vehicles, this rapid depreciation creates the same negative equity trap seen across the broader market. Another problem is the infrastructure, or lack thereof. While efforts have been made to expand charging networks, many areas of the United States still lack the necessary infrastructure to support widespread electric vehicle adoption. This has left potential buyers hesitant to make the switch, particularly in rural or less densely populated regions. Manufacturers, meanwhile, have overestimated demand. Ford, for example, has struggled to move its F-150 Lightning and Mustang Mach-E models despite offering steep discounts. Inventory levels for electric vehicles are at record highs, and the costs associated with producing these vehicles have placed additional financial strain on automakers. The electric vehicle conundrum illustrates a broader issue within the industry, a disconnect between what manufacturers are producing and what consumers are willing or able to buy. This disconnect is yet another factor driving the car market crash. An industry out of touch. What ties all these issues together is a fundamental misalignment between the automotive industry and its consumers. For years, automakers have focused on maximizing profits, often at the expense of affordability and practicality. They've loaded vehicles with expensive features, shifted production to lower-cost regions, and hiked prices to unsustainable levels. But now, the cracks are impossible to ignore. Buyers are no longer willing to pay $75,000 or more for a truck, or $60,000 for a family SUV. Even with discounts, many vehicles remain out of reach for the average household. And with the rising cost of living, fewer people are willing to take on the financial burden of owning a new car. The car market crash of 2025 isn't just a temporary setback, it's the result of years of systemic issues coming to a head. And as we've seen, these problems aren't going away anytime soon. From inflated prices and rising insurance costs to loan denials and negative equity, the forces driving this crash are deeply entrenched. Crumbling brand loyalty. As the car market implodes, one of the less visible but equally catastrophic effects is the erosion of brand loyalty. For decades, automakers like Ford, Toyota, and Nissan have relied on their reputations for quality and reliability to maintain a loyal customer base. However, as prices rise and value plummets, even the most trusted brands are losing the confidence of their buyers. Consider Nissan, a company once synonymous with affordable, reliable vehicles. In recent months, Nissan has announced drastic measures to stay afloat, including cutting 9,000 jobs worldwide and reducing production by 25%. Their anticipated profits have dropped by 70%, and last quarter alone, the company reported a $60 million loss. These figures highlight the financial strain facing not just Nissan but many automakers. Even Toyota, which has long been seen as a benchmark for reliability and practicality, is struggling to sell models like the Tundra and Tacoma. Buyers who once gravitated toward these trucks for their affordability are now balking at prices that start at $43,000 for a base model and climb to $75,000 for higher trims. The result, thousands of unsold vehicles piling up on dealership lots. This growing disconnect between automakers and their customers is more than a short-term hiccup. It's a fundamental shift. Consumers are beginning to question whether the brands they once trusted still offer the value they need. And as loyalty wanes, so does the long-term viability of these once dominant companies. The silent warning. Beneath the surface of the car market crash lies an alarming trend that many overlook: the collapse of wholesale vehicle values. Wholesale values represent the auction price of vehicles, which dealerships rely on to determine trade-in offers and inventory pricing. Over the past quarter, wholesale values have plummeted by 18%, signaling a deeper instability in the market. This decline in wholesale values is more than just a financial metric. It's a stark indicator of the market's health. When wholesale prices drop, it means dealerships are struggling unwilling to offload inventory even at discounted rates. This in turn affects trade-in values for consumers, who find themselves receiving far less for their vehicles than they might have expected. For dealerships, the situation is even more dire. Many have traditionally relied on wholesale auctions as a fallback, using them to offload unsold inventory quickly. But with wholesale values in freefall, this safety net has all but disappeared. Dealerships are now forced to sell vehicles at significant losses or hold on to them indefinitely, accruing additional flooring costs and compounding their financial struggles. The collapse of wholesale values is a silent warning that the car market crash of 2025 is far from over. As dealerships lose one of their most reliable tools for managing inventory, the pressure on the industry continues to mount. The used car market rebounds. Amid the chaos, one sector of the market is showing signs of life: used cars. After years of inflated prices, the used car market is finally beginning to cool. This shift is offering some relief to buyers, but it comes with caveats. For example, lightly used vehicles, which were once selling for as much as their new counterparts during the pandemic, are now available at more reasonable prices. A GMC Yukon XL Ultimate Edition with 26,000 miles, which might have sold for over $100,000 new, is now listed at $84,000. While still expensive, this represents a step toward affordability. However, the rebound in the used car market isn't as promising as it seems. Prices remain significantly higher than pre-pandemic levels, and many buyers are still priced out. Additionally, the influx of repossessed vehicles has created a glut of inventory, driving down values further and eroding consumer confidence. For those looking to trade in their current vehicles, the used car market offers little comfort. Negative equity remains a significant barrier, with many owners finding that the value of their trade-in is far less than what they owe. This dynamic leaves potential buyers stuck in their current vehicles, unable to take advantage of falling prices. Stellantis and other giants. As the market spirals, some of the world's largest automakers are facing existential questions about their futures. Stellantis, the multinational conglomerate that oversees 14 brands, including Dodge, Jeep, Ram, and Chrysler, is a prime example. The company has seen its stock drop by nearly 50% in just 6 months, and executives are now reevaluating the viability of their portfolio. One of the most pressing questions facing Stellantis is whether all 14 of its brands can survive. With profits dwindling and competition intensifying, the company is considering cutting some of its underperforming divisions. Dodge and Chrysler, once cornerstones of the American automotive landscape, are among those rumored to be on the chopping block. This internal turmoil isn't unique to Stellantis. Other automakers, including Nissan and Ford, are grappling with similar challenges. Nissan, for instance, has been in talks about a potential merger with Honda, a move that underscores just how desperate the situation has become. While mergers can offer short-term relief, they often lead to significant disruptions, including layoffs and factory closures. For the industry as a whole, these struggles signal a broader shift. The days of sprawling conglomerates dominating the market may be coming to an end. Instead, we may see a leaner, more competitive automotive landscape emerge, one where only the strongest brands survive. The future of dealerships. For dealerships, the crash has turned into a fight for survival, with rows of unsold inventory gathering dust on their lots. Many dealerships are facing financial ruin. Every month they pay flooring costs, interest on their unsold vehicles that eat into their profits and push them closer to the edge. To entice buyers, dealerships have resorted to aggressive discounting. Price cuts of $10,000, $15,000, or even $20,000 are becoming commonplace, particularly for high-end trucks and electric vehicles. But even these steep discounts are often not enough to lure buyers who are either priced out of the market or unwilling to commit to long-term loans with crippling monthly payments. This has forced dealerships to get creative. Many are offering incentives like 0% interest for limited terms, extended warranties, or bundled maintenance packages to sweeten the deal. However, these measures come at a cost, further squeezing already razor-thin profit margins. The dealerships that survive this crash will be those that adapt quickly to the new reality. This might mean shifting focus to smaller, more affordable vehicles or investing in used car sales, where demand is showing signs of life. Others may need to consolidate, merging with competitors, or scaling back operations to weather the storm. For many, however, the writing is on the wall. Bankruptcy looms as a real possibility. Global implications. The collapse of the United States car market has far-reaching implications that extend beyond its borders. As one of the largest automotive markets in the world, changes in the US ripple through global supply chains, impacting manufacturers, suppliers, and economies worldwide. Take South Korea and Japan, for example. Both countries heavily rely on exports to the United States to sustain their automotive industries. With American buyers retreating from the market, automakers like Hyundai, Kia, and Honda face declining sales, forcing them to rethink their global strategies. Some are already pivoting to other regions, such as Europe or Southeast Asia, where demand remains strong. Meanwhile, in Europe, automakers are watching the crash closely as a cautionary tale. The lessons from the United States underscore the risks of overpricing, overproduction, and an over-reliance on consumer debt. European manufacturers, while not immune to similar challenges, are making adjustments to avoid a similar fate. This includes increasing their focus on smaller, more efficient vehicles and doubling down on electric vehicle production in regions with robust charging infrastructure. The most profound shifts, however, are occurring in emerging markets. Countries like India and Brazil are seizing the opportunity to fill the gaps left by struggling American automakers. With their lower production costs and growing consumer bases, these nations are well positioned to emerge as major players in the global automotive industry. A glimmer of hope. While the crash has brought hardship for many, it also presents unique opportunities for savvy buyers. As dealerships become increasingly desperate to offload inventory, prices on new and used cars are beginning to fall. For those with the financial means and patience to navigate the turbulent market, there are deals to be had. For instance, lightly used vehicles that were once priced higher than their new counterparts are now seeing significant discounts. Models like the GMC Yukon XL or Toyota Highlander, which commanded premium prices during the pandemic, are now available at more reasonable rates. Even electric vehicles, which were once marked up by tens of thousands of dollars, are being offered with substantial discounts as manufacturers adjust to sluggish demand. However, buyers should approach these opportunities with caution. While prices are falling, financing remains a challenge. High interest rates can quickly negate the savings from a discounted purchase, turning a good deal into a financial burden. For this reason, cash buyers, or those with access to low interest financing, are in the best position to capitalize on the current market conditions. Additionally, buyers should be mindful of the long-term costs associated with their purchases. Vehicles with poor resale values, high maintenance costs, or limited warranties may seem like bargains up front, but can lead to headaches down the road. Doing thorough research and considering total ownership costs is more important than ever in this volatile market. The new normal. The car market crash of 2025 is not just a temporary downturn, it marks the beginning of a new era in car ownership. As prices adjust and financing becomes more restrictive, the way people buy, sell, and think about vehicles is undergoing a fundamental shift. One of the most significant changes is the growing popularity of car subscriptions and leasing models. For consumers hesitant to commit to long-term loans or outright purchases, these alternatives offer flexibility and reduced upfront costs. While subscription services are still in their infancy, they represent a potential solution to the affordability crisis plaguing the industry. Another emerging trend is the rise of smaller, more efficient vehicles. As buyers seek to stretch their dollars further, demand for compact cars, hybrids, and electric scooters is on the rise. Automakers that can pivot to meet this demand stand to gain a competitive edge in the years to come. Finally, the crash is accelerating the adoption of shared mobility solutions. Car sharing services, which allow users to rent vehicles on an hourly or daily basis, are gaining traction in urban areas where owning a car is increasingly seen as a luxury. While these services are not a substitute for car ownership in all situations, they offer a glimpse into a future where mobility is more accessible and less tied to personal assets. Looking ahead, the car market crash of 2025 is a wake-up call for the automotive industry and consumers alike. It has exposed the vulnerabilities of a system built on inflated prices, easy credit, and unsustainable practices. While the immediate outlook remains uncertain, the crisis also presents an opportunity to rebuild a more resilient and equitable market. For consumers, this means rethinking the role of cars in their lives and exploring alternatives that better suit their needs and budgets. For automakers and dealerships, it means adapting to a new reality where affordability and sustainability are paramount. The road ahead will not be easy, but it is clear that the car market is undergoing a transformation. Whether this leads to a brighter future or deeper challenges depends on the choices we make today.